Good evening, everyone. Good evening. We will start in just a few minutes. Make yourselves comfortable, and we'll be right there. We're having a little bit of a trouble with our microphone. We will be connected very soon. I hope you guys hear me okay. I'm trying to fix it, and we'll get started. Good evening, everyone. Good evening. I hope you hear me okay. Apparently, we have a little bit of problems with the microphone here. I'm guessing you can hear a little bit of ups and downs during the webinar in my voice. Please let me know through the question bar when it's down, so I'll be able to fix it right away. So, welcome everyone to the webinar. My name is Jay Dresner. As you can see, I'm an financial advisor at Tradeo. I use a lot of technical analysis, and that's what we're going to talk about today. Technical analysis. Technical analysis is not necessarily, or not specifically, indicators. It's not specifically. It's not something specific. It's something very, very general, and that's what we are going to talk about today. If you have, we'll get there. We'll get there. The questions. It's very, very important that you guys use the quality, change the quality of your picture and the little settings on the bottom right side of the video. That is the video is showing. Okay, you'll be able to change it to a 1080p or 720p, which is basically HD, and you will simply be able to get a better picture of this webinar. If you have any questions, please do not hesitate to ask. Ask me in the questions bar. I'm looking at it live during the webinar. I'm going to be answering it orally. I'm not going to answer it one by writing. So don't hesitate to ask me anything. Okay, don't hesitate. I'm guessing you're going to have lots of questions during the webinar. Again, do not hesitate to ask. So before we get started, we got to go through the basic information. Well, the basics of trading on Tradeo. Okay, everything that we do, we calculate in pips. Okay, pip is the percentage in point. The pip is the 4-decimal number that a given exchange rate can make. This is actually what we look at every trade we're placing. When we place a trade on euro US dollar, when we place a trade on pound dollar, whatever we're trading on, it is important that you guys understand that this is what we're looking at. Why? Because we leverage our money. Okay, well, leverage basically is money the Tradeo lends you in order to be able to make it more accessible if you have a smaller investment, or to make it more significant. More significant. That's the word I'm looking for. So that way you'll be able to trade bigger than what you have. We allow our traders to trade 200 times the amount of how much you have in your balance. Basically, if you have $1,000 in your account, you have the possibility to trade up to 200,000. It is a very, very big amount, but I wouldn't recommend it as we have the margin. We'll get to the margin in just a second. Everything that we do in terms of volume. Okay, we place trades. We place trades in terms of volume. Okay, 0.01 is the smallest trade that we can place on currencies. Okay, every trade of 0.01 equals to 1,000 units of what we're trading on, which means that if we want to trade euro US dollar, if we want to buy euro US dollar, we will buy 1,000 euros with dollars, and every pip is worth 10 cents. Margin. The margin level refers to the situation when a margin in an account is depleting. Basically, this is sort of an alert for us and a stop out for you whenever you're trading. I hope you guys hear me okay. If you don't hear me, please, again, let me know that you don't hear me. But I'm having, for those who are joining us, and I see more people are joining every minute. So I'm having a little bit of trouble with my microphone. If you don't hear me okay, let me know, and I will try to fix it right away. Again, for all the joiners, if you have any questions, ask below, and of course change the quality of the picture. What we are doing right now, we're going through the basic information of technical and of trading in general, and then we'll get to the part where we talk about technical analysis. Um, the margin. The margin level, as we said, it shows us when the money in our account is depleting, meaning if we're placing a trade and it's going against us, or if we place a big trade and not even if it goes against us too much, but it goes against us a tiny bit, that is enough for the trade to get in the margin call or to a stop out. So be careful, be very careful when you're trading. Don't trade with the high leverage. Be careful, take it easy. We all want to become rich. We all want to become very rich. We all want to make big trades and make big bucks. But we have to make sure that whatever we do it carefully and we're cautious. It's your money. We don't want you to lose your money. Trade small. Be careful. However, margin call is when your account reaches the 100% and this stops out at 30%. If you want any more information about that, you can ask me in private later on. So, we gathered here tonight, or this evening, or this morning for our Canadian friends. We gathered here tonight. In order to speak about technical analysis. Technical analysis is basically analyzing the market psychology. Okay, the market has a psychology. The psychology is mostly based on history of fluctuations of the markets. That history, okay, whatever happened in the markets in the past is based on people buying, people selling, supply, demand, and many other factors that make movements in the markets. Okay, in order to predict and to forecast the future of the markets, we learn the psychology of that history. It is very, very important that you guys understand it. Naveen, I know it's a low audio. I'm sorry about that. As I said, we have small issues with the microphone. I tried changing it several times, but it's not working. It is important that we understand that the history and whatever is happening in the markets is due to or happens because many factors, like we said. If it's people buying, maybe people selling, or whatever the reason might be. In order to do it successfully, meaning in order to predict the market successfully, we will use the following tools. We will start with support and resistance. We will follow it by Japanese candlesticks, chart patterns, and technical indicators. If you came here tonight because you think that I'm going to show you a secret recipe for how to predict the market, you're wrong. Why are you wrong? Because predicting the market, as I say usually, my name is not Jesus and my father is not Muhammad or Moses. I'm not a prophet. No one is. We try to predict the next move of the market, and by that, we basically understand, or we're trying to understand what will happen. We're trying to predict it. It's a prediction. It's a forecast. Okay, it will not. It's not. It's never 100%, and it's a very risky business. So you gotta make sure that you always trade with low volume, with low leverage, and you make sure that you follow the following steps. Either it's going through support resistance, okay, following by Japanese candlesticks, chart patterns, and technical indicators. When you have all of those tools together and you follow those steps, you will make sure that you will most likely make lots of money. Why? Because you will be very disciplined. You're going to follow those steps. If you're not going to follow those steps, you will lose big time. So it's very, very important, very, very important to follow those rules. If you want to make money in the markets, follow those rules. Support and resistance. The market movements are constantly forming resistance and support, as you can see in the picture below. Okay, in this picture you can see that the market is creating a support and a resistance. Okay, and you basically can see the lines of the support and the resistance. The support and the resistance is basically just like a ceiling and a floor. Okay, as you can see, the market is moving, and that screenshot of the chart, the market is moving in between the ceiling and the floor, the support and the resistance. Okay, the support is the floor, the resistance is the ceiling. When it crosses the support, it might be a very good indication for buy, for sell, sorry. When it crosses the resistance, it might be a good indication to sell. Meaning, if it will cross that line over here, it might fly up. If it crosses the line down here, it might fly back down. But when we see that 1, 2, 3, 4 candlesticks is not crossing, it's not going back. For example, over here we can see it went up, it's just corrected a little bit and created another support line, and then it started going up. And then we had lots of ups and downs, and forget about what happened later on. As you can read below, the resistance is formed by the highest point reached before a reversal, and the support is formed at the lowest point reached before the reversal. It is important to mention that you cannot use only one support line or only one resistance point. For example, only this or only this in order to make it a support or resistance. You gotta have a couple in order to call it a support or a resistance. We follow the support and resistance, we follow it by the Japanese candlesticks. Now you gotta understand that the Japanese candlesticks, it's not only that it's in Japanese, I'm kidding, it's not in Japanese, but you gotta understand that Japanese candlestick is a language. It's a language that basically gives you an indication of what's gonna happen next. In order to read the candlesticks, you gotta understand, as you can see, as you can see in front of you, a Japanese candlestick is a style of financial charts used to describe price movement of a security, stock, or currency. Each candlestick typically shows a time scale. For example, we can look at it on the 1 hour, 4 hours, 30 minutes, and we will show you later on your on my MT4 on our website on our MT4. You're going to see basically what is the how exactly it works with the time frames. For those who don't know MT4, for those who don't know the web trader, this is what we use in order to trade. This is the software we're using in order to trade. A candlestick that goes up is called a bullish or a bull candle, and a candlestick that goes down is called a bear candle, a bearish candle. As you can see, there is a very nice design over here of a bull and a bear. The bull candle will open at the bottom and will close obviously at the top. Why? Because going up. Okay, the market goes up. The euro versus the dollar is going up. The day starts at 1 a.m. and it closes at 12 p.m. Okay, let's say this is a daily candle. It will open over here, close over here. As you can see, there's a very small thin line in between. This basically shows you where was the candle within that given time. Same goes for the bear candle, but the open price will be at the top and the closing price will be at the bottom. There's a few rules in order to read that language. There's a few rules in order to read that language, okay? Before we can even go through that language, we gotta understand what are those rules. Japanese candlesticks representation offers a help to the decision before placing a trade, which means that we cannot rely 100% on it in order to make a trade. I'm not going to see a candlestick and going to say, hey, that's a rising star. It's not what you have to do. Okay. You need to use that to help you in order to place a trade. Japanese candlesticks are not sufficient alone to take your decision. We must use other tools in order to place trades. It's the same thing as what we said. Timing should never be a change for decision making. Meaning, when you're looking at when you're looking, candlesticks can give two indications. Yes, that's the continuing of that. Candlestick can give two indications completely opposite on the next movement. For example, you see a reversal on 30 minutes on the chart of the 30 minutes, but the 4-hour chart can well indicate that the trend should be continuing. Therefore, you must never change your timing to take your decision. When you see a candlestick, a shape of a candlestick on the 30 minutes, don't look at the 1 hour, the 4 hours, or the 5 minutes, or the 1 minute, or the 1 day in order to find the same candlestick, because you won't. Okay, you cannot use two time frames in order to make a decision. Okay, use only one time frame. A candlestick should always be analyzed according to the trends or the movements that preceded it. Sorry. Yes, a candlestick. In order to understand a candlestick, you gotta see what's the next candlestick. Before the candlesticks does not close, or before the time frame doesn't close, if we're looking at the 1 hour, 2 hour, or 4 hours, sorry, or the 1 day, or 30 minutes, before the 30 minutes is not over yet, you cannot make a decision on whether, because all the time it could change. Okay? We will look at it on the 1 minute in order to understand it later on, but you cannot basically rely your trades on that. You should always wait for confirmation of the next candlestick to validate the decision. This is again the continuing of this of the first thing we said. Okay, never rely on an open candlestick. Wait until it closes before you make your decision. We learned the Japanese candlestick by their shapes. There are many shapes, and each one has a name. Okay, my name is Jay. And the CEO of Tradeo's name is Jonathan. Okay, this candlestick is called a hammer, and this candlestick is called an inverted hammer. What does it do? How does it affect? How does it affect? What does it do? Why does it do it? We will talk about that in just a second. As you can see, there's many shapes. Each shape is very confusing. Okay, I didn't make that chart in front of you. I have obviously downloaded it from somewhere. Google, don't tell anyone. Basically, this chart in front that we can see in front of us, I want to show you live. Well, something that happened in the past, 24 hours or maybe 36 hours, and it actually gave us a good indication for what's going to happen next. I want you guys to focus on the inverted hammer. The inverted hammer should give us an indication over here, as you can see, of a sell. Okay, this happened. Inverted hammer, boom, it dropped down. Why did that happen? Let's go to the MT4. Let's go to the MT4 and you'll see for yourself. Okay, this is the webinar account. You can find this account on Tradeo. Okay, it's an account with $1,000 credit and $200 and 200 euros on this balance. Do not copy that account for testing. We're using it a lot for testing and presenting on webinars. So do not copy this account. But let's learn something. As you can see, lots of candlesticks up and down, up and down, up and down. We're looking at the 1 hour frame of the Euro-US dollar. Okay, and we get the first indication of what's going to happen next. What's going to happen next? If this candlestick happens, it doesn't necessarily mean that you're going to get a 100% signal on what's going to happen. Okay, it is important that you guys understand. It's important that you guys understand that it just doesn't work that way. Okay, we use 1, we use 2, we use 3 all together. Okay, we use support resistance, we use candlestick, chart patterns, and technical indicators. So make sure that you don't rely all of your trades only on candlestick shapes. It is also important to mention, because I see here more people are registering, more people are connecting. Every minute we have more and more people are connecting. So first of all, welcome to all the rest of the people that are connecting. Second, don't hesitate to ask any question. Third, I know I have a audio problem. I'm trying to speak into the speaker. For some reason, it's giving me some issues. I tried with several other microphones, still didn't work. Apparently, I have something in my computer, and someone called the IT. Yeah. So basically, as we said, it's important to mention again. I'm not going to give you here some specific details about specific ways or specific indicator. How exactly does it work? This is not technical analysis. You want to do good trades. You want to trade and base your trades on technical analysis. Read. There is so much information online. Read. If me, as your account manager, will realize that you are a serious trader and you have a lot of potential, I will invest in you more money. More money. I will invest in you more time. Time is money. I will invest in you more time and teach you one on one the down to details. If you're not as serious or you don't have as much as time, I will invest, but not as much as I see that you're serious. It's important to mention that I don't care how much money you have in your accounts, because, well, of course I care, because it's my income on your volumes, but it's very, very important that you guys understand as well that I am here in order to make money. If someone with a lot of money is obviously more serious, I will help you more understanding down in specifics what is happening in the markets. So as we can see over here, the highlighted candlestick. Let's minimize this and go. Okay. This is what we're looking at. As you can see, inverted hammer is exactly what happened over here. We'll zoom in a little bit so you guys can see. Okay, you guys can see it's an inverted hammer. Okay, it opened at the bottom, went all the way up to here, went down to here, and closed over here. The next thing that happened, it opened over here and started dropping. It started dropping big time. It started dropping big time. Okay, we'll talk about the big time later on. We'll talk about the big time later on. But for now, what we can see is that it did make a change in the trend. Okay, it was an uptrend. It did make a change in the trend. Beforehand, it went up, and then boom, it smashed. Okay, we'll talk about that. We'll get there. So this is one inverted hammer. This is one shape of a candlestick that you can just learn. Okay, there's many more, and you're not going to learn it in 1 second. It takes time to watch the markets, to look at the charts, to get into the better understanding of it, and therefore you will understand what is the next move of what you're doing. The next thing that we want to talk about tonight is the chart patterns. As you can see, we study graphs and charts of historic data to find trends and predict trends. Trend reversal, sorry. There's no commas over here, which includes the observance of certain patterns and characteristics of the charts to drive resistance level. Head and shoulders patterns and double bottom or double top patterns, which are thought. Sorry, I'm not very focused. Which are thought to indicate trend reversals. Okay. Basically, the chart patterns is a drawing of something that is happening. Something is happening. A drawing is happening. We see a shape of something in the chart. Okay. I'm sorry, my English is not my first language. So my apologies for that. But basically, as you can understand, a chart pattern is a pattern, a drawing of the movements of the markets. It's going up, it's going down. In what direction does it go up? What does it draw us? once I was speaking to a client, I was connecting with a team viewer to her screen, and I'm looking at a chart, and I didn't even realize what I'm looking at. I don't remember exactly what it was, but I remember I told her, "Wow, beautiful charts," and she tells me, "Jay, what?" I said, "Yeah, look at it. It's a beautiful pattern. Look at what's going on over here." And I explained to her in basic, in 2 words. I explained to her what exactly does it mean, and she understood. And you guys are going to understand. As you can see, there's a list of patterns. Okay, you can see the source on the top of where I got this chart, but you can see the a list of patterns. Each pattern, of course, represents something else, or gives us a different picture of what is happening. However, I want to focus on the rising wedge. The first one on the top left, the rising wedge. What is it? You will get an understanding after we look at the graph and we see together what is a rising wedge, and you will understand for yourselves how exactly a market can draw on the chart. What do you mean, Jay? What do you mean? People are asking, what do you mean, Jay? Drawing. So you will see the Mona Lisa of the charts. The rising wedge. The rising wedge is a bearish reversal pattern formed by two converging upward slit. There's a typo over there. Slants, no. To confirm a rising wedge, there must have oscillation between the two lines. Each line must be touched at least twice for validation. As you can see, one, two, one, two, three, four, five over here. If we take it over there, um, you can see the shape of exactly what is going on over here. It's going up. It's going up, big time. Correcting a little bit, going back up, correcting a little bit, back up, and now every time it goes again back up, you can see it becomes the turn becomes the movement, the difference between the higher price and the lower price is a little bit. It's getting shorter and shorter. Okay, over here is a lot wider. Okay, in comparison, and over here is a lot squeezes into it. We'll go for several minutes. I want to see it on the chart. Let's watch it on the chart. There you go, full screen. As you can see, this is the euro US dollar. We were looking at the candlestick before, and now what we can see is, now what we can see is the euro US dollar with the rising wedge. As you can see, this is the form. No, I actually want it. I would change it from the candlesticks just so you guys understand. Okay, you can see for yourself the pattern, okay, the drawing that it caused. And then we have two indications. We have, let's put back the candlesticks. We have the candlestick as for a start. And then we have the rising wedge that basically indicates us that, wait, something is going on over here around this price. It's squeezing into this corner over here. It's squeezing into this corner over here. And it gives us basically an indication whether to buy or whether to sell, or it's giving us an actual direct signal: sell euro US dollar. Now it's important that whatever you see over here, I'm not giving you a direct signal here to buy or sell euro US dollar. It's important to mention it. We're just watching a graph, and we want to learn. Okay, according to our regulation, we are not allowed to provide direct signals. So it's important to mention it. However, um, Mark, I appreciate that. I know that. Mark is saying that my voice is fading in and out. I know I have a problem with the microphone today. So accept my apologies for that. Yeah. So basically, this is basically a pattern. Is an example for a pattern. But hey, Should we rely on it actually? Can we actually, before all this happened, can we actually rely on it, on this pattern plus candlestick? The answer would be simply no. The question would be, what would we do in order, what would we do in order to move on, in order to place that trade, in order to understand, to say, hey, that's a sell signal. I should sell right now. Okay, we need a little bit more confidence in what we're gonna do, and for that we have technical indicators. Technical indicators are mathematical calculation based on historic price and volume. Okay, people are buying, selling. People are moving in the markets, and you got to understand that this is causing lots of movements when people are buying and selling, supply and demand. Hey, characterizing the state of the value of each asset, and therefore we can learn and predict the next move of the markets. And most of the times, we will use multiple indicators in order to predict it right. Okay, just like we use candlesticks or chart patterns. Okay, we will use multiple indicators in order to make sure that we have the right indication of what's happening next. You got to make sure there are many indicators, and some can give you a misleading indication. So it's important to follow the right ones. Okay, if you have a specific indicator that you want to use and you want to ask me before, hey, do you know this and this indicator? Perhaps I would say no, because I wouldn't know it. There's thousands or millions of indicators. But most likely I would say yes, and I will give you a better explanation of what it is and how reliable it is. Oh, no, that's not it. That's not it. Don't go away yet. Okay. What we want to look at is at this graph with an indicator and an example of an indicator. As I said, there's many indicators out there. This indicator that you can see, what I've just added to my screen, is called Ishimoku. The Ishimoku is, again, Japanese, that invented that indicator. I'm not going to get into the specifics of this indicator because it's going to take me not 30 minutes, not an hour, not 2 hours. It's going to take me weeks, or it's going to take you guys weeks to understand the way it works. However, it's the most, I wouldn't say the most, but one of the most reliable indicators that I've seen in my lifetime trading the financial markets. This indicator is divided to 4. One line, which is the green line over here, is basically showing us the psychology of what happened in the past. 2 lines, red and blue, showing us what is happening in present. And the cloud that you can see in the background is basically showing us, giving us an indication what will happen next. What's going to be next. Now, again, I'm not going to get into specifics of this indicator. This is a very, very, very complicated indicator. I can tell you that I have many colleagues, people with lots of experience, if it's in Wall Street itself or in the city in London or wherever it is, people who are trading lots of money. Ishimoku, Scott is asking me to spell out the indicator. Ishimoku is ICHIMOKU. 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 If you want to find it on your MP4, you should go to the navigator or Control and together, and you will find it over here. Ishimoku, yeah, I spelled it right. Thank you, Scott, for putting me at the spot over here. However, this indicator, why am I showing you this specific indicator? One thing about this indicator is that one indication that we can understand is it gives us many indications. You got to understand, it gives us many indications about what is happening or what will happen or what did happen. However, it's important to mention that this is basically, as we can see over here, it gave us an indication, a sell indication. Okay, a sell indication. So we have the candlesticks, we have the chart pattern, and we have an indication. Okay, this indication, as I said, indicator is divided to four. Okay, the past, present, and future. Okay, this present one, as we can see, every time the blue line gets over, the red line gets over the blue line, or the blue line gets over the red line, okay, this is also sort of an indication. Over here, as we can see, the blue line got over the red line. Okay, right over here, we can see it's got over the red line. It crossed it. Both got into the cloud, crossed the cloud, and kept on falling. Okay, I did not this morning. I think it was last night. I sold euro US dollar big time. It was so obvious. It was so obvious. If we go on the daily, you can see so much resistance at this point, so much support, so much resistance. Sorry. Okay, beautiful chart pattern, beautiful candlestick on the 1 hour. Okay, not to talk about the other frames, and Ishimoku indicating us, hey, sell that currency. Euro is gonna get weaker. So I sold big time, and I'm making some nice gains on that. So again, as I said in the beginning, today I don't want you to think that technical analysis is such a simple thing. Technical analysis is not such a simple thing. When someone tells you trade with RSI, stochastic, Bollinger Bands, moving average, rely on those, put this one and this one together, it's not as simple as you think. It is working. I'm not saying it's not. It is working. And you should rely on it on smaller terms, on shorter terms, on shorter time frames and shorter terms. And if you have $500,000 in your account, I wouldn't tell you rely on RSI and stochastic together. Okay, this is something that technical analysis is something very, very complicated. Lots of calculations, lots of mathematics, lots of statistics, lots of indications, lots of thinking, lots of concentrating, reading, looking, checking the charts, checking the candlesticks, checking the indicators, checking the patterns, checking everything together. Every single factor has every single thing has a factor here, has a is very, very important to look at. And you got to make sure that you follow those rules. So we said check for support and resistance, check for candlesticks, read about it. If you want, I can teach you about it. It's very simple to understand. It's hard to memorize. It's hard to memorize. It's simple to understand. If you want, you can print out for yourself a nice piece of paper where you have those candlestick shapes. Have it in front of you, and you look at it, and you see, hey, this happened. When this happens, when a candlestick happens, it doesn't necessarily mean that the next one is going to be. It might show you a different indication on the next one and a different one until you see, hey, this one is adding up, together with the patterns, together with the indicator, together with all those things together, and that will make your trades successful. Be very, very careful. Be very, very careful when you trade. Don't trade big. Don't trade big. Don't trade with high volume. It might wipe you out. Be careful. I don't want you to lose your money. We all want you to make lots of money. So be very, 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 very careful. That's it. That's what I have to tell you about technical analysis. If you thought today that you will come and learn a specific indicator, you're wrong. Perhaps we're going to do following webinars about technical analysis, learning more candlesticks, more chart patterns, more more indicators. Ask me some questions in private. You can send me an email. Okay, I will show my email in just a few seconds. I will give you my number. If you do have any questions, any problems, any issues, let me know. Now, if you have any questions that you didn't have the guts to ask me earlier, now is the time. I will answer questions if you have any. Julius over here is asking me, what about Bollinger? So as I said, Bollinger Bands are reliable. Okay, you have to add a few indicators to that. It is a very it's a very nice indicator, but I wouldn't rely only on Bollinger Bands. Rely on, add to that stochastic and RSI, like I said before. Those three together can give you a good indication. Scott, it's my pleasure. It's my pleasure to be here with you. Any other questions? I guess I was clear. If you do think about other questions, hey Simon, you're thinking fast. About the chart, yes, you want me to run back the charts. Okay, no problem. Let's go to the charts. The chart pattern. Okay, the chart pattern. 1 second. There you go. No, exit that and give you the chart pattern. Okay, the chart pattern is a shape. Okay, the shape is a drawing of something. Okay, this is just an example. There's many shapes and many drawings of charts. Okay, it doesn't necessarily indicate something specific. But when you learn, when you see lots of graphs, and you follow when you do have a lot of experience, you will understand, you will see for yourself the difference between the shape of the charts. Okay, if we open right now, um, let's open. I'm trying to think. What else do we have here that we can talk about? I have nothing on the top of my mind right now, but we can if you want in private, I can show you many other examples about charts and how to read the chart patterns. And I hope it will help you understand the idea of the chart patterns. Okay, this is a rising wedge, as we said. This is a rising wedge, and I will explain to you that in private if you did not understand. Basically, as we said, it's a drawing. It's the way the market works. As you can see, it did draw us. 1 second, give it back. It did draw us. It's sort of over here. The movement is a lot stronger. It's a lot stronger. And then keeps on going up, but it's getting squeezer and squeezer. Smaller. The movements are getting smaller and smaller. Um, it's the way it's designed on the graph in front of you. I will show you many other examples to you. If you don't understand it, I will show you many other examples, and I hope you will understand. Julius is asking how you choose investment period, then open position. I mean, 15 minutes, 1 hour, 1 day. Julius, it is very important that you understand. You decide what kind of trader you are. Okay, if we want, we can do a whole webinar about what kind of trader. Yesterday, we actually had one of my French colleagues who made a webinar about what kind of trader am I. Okay, scalper, swing trader, day trader, whatever you are, whatever trader you are. It is you decide what time frames you're using. If you have, I'm not saying about you specifically, Julius, but I'm talking in general. If a client has $1 million in his account, obviously he will open longer term trades. When he has a few thousands, he will place shorter term trades. Okay, he's not even going to look at the 1 hour because he doesn't care what happens. 1,000, a few thousand will look at the 1 hour chart. because it's a short term. He wants to make small bucks. Okay, $50 here, $100 there. It's no biggie. When someone looking with $1 million on it, he wants to make a lot bigger than that. He will trade with less leverage and will obviously go for the longer run. Okay, I can tell you that I know many traders that ever since the beginning of when was that? The beginning of 2014, they sold euro US dollar, for example. They're making millions of dollars right now, millions of dollars. So you decide what kind of trader you are with your investment, with your patience, with your disciplines, which is even something we haven't talked about. Disciplines and patience, which is the main key of trading. Scott. Scott is asking to explain the margin level in the P&L on your trade board. What you're talking about, what you're referring to is what is the margin level. We had that in the previous webinars. We spoke about that. If you want the sound quality, it will be a lot better there. But what's important is that the margin level basically refers, and we spoke about it at the beginning of the webinar, and this webinar as well, it refers when the money in your account is depleting. Basically, when you're leveraging your money, when you're using a 10 to 1, 20 to 1, 100 to 1, 200 to 1, meaning if you're trading with 1,000 and you're placing trades that are worth 100,000, it's basically your basically it's a percentage that decreases or depleting whenever the trades are going against you, so you don't lose that money we allow you to trade with. That's basically the margin level. The P&L basically stands for profits and losses. Profits and losses in basically when you're placing trades, whether you're gaining or losing money. If you have any credits on your account or a credit bonus, call it whatever you want, it refers together with the bonus, gives you a total of what you have in your equity. Donald, we will do all types of webinars. I want you guys to understand all types of webinars, all types of traders. Donald here is asking if we can do a webinar talking about the type of traders. Yes, we can. Everything is doable. Yeah. Trading, Julius is saying here that he's trading with 250 euros, and he's asking as well, what about Fibonacci? Fibonacci, Andrew's pitchfork, all those kind of, it's to be honest, I don't really believe in it. Okay, but as you're saying, you're trading with the 15 minutes, you can use Fibonacci. It could help you. Don't use it alone. Use it with a different indicator, like moving average or perhaps MACD or volumes or any kind of indicator that you can use together with. Any other questions, ladies and gentlemen? Any other questions? It is important to mention that all webinars are published immediately right after the webinar on our YouTube channel. I think it's Tradeo Social Tradeo, or Social Tradeo, Tradeo Social. I don't remember what's the exact name of our YouTube channel. Yeah, Tradeo Social. That's the name of the YouTube channel. You can find all the webinars over there. If you missed one or anything like that, you can find it over there. However, it was a pleasure. A pleasure. It was really a real pleasure. I'm sorry about the call, the quality of the of the audio. My microphone, as I said, wasn't working very well today. Decided to bail on me today. If you have any questions, please do not hesitate to ask me. Ask me at any time at jay.d@tradeo.com or call me at 44203 plus 44 for England 203-608-6616 plus 44-203-608-6616. Don't hesitate to contact me. I will answer your questions with pleasure. It was a pleasure being here with you. It was a pleasure hosting this webinar. Thank you all for attending. Have a great evening and bye-bye.